Silver didn't just touch a new high, it detonated through historical ceilings. On December 11th, spot silver surged to what appears to be an all-time high near $64, only to fall to roughly $62.70 within the next 12 hours. To the untrained eye, it looks like a simple pullback. But this wasn't a correction, not even close. Something far bigger is moving underground. Because while price action grabbed the headlines, the real story was unfolding inside the COMEX vaults, where registered silver appears to be draining at a velocity we haven't seen in modern market history. Some analysts estimate withdrawals happening nearly 145 times faster than typical 2024 patterns. If this pace continues, several industry observers are openly warning registered COMEX silver could hit critically low levels by late January. That's not normal. That's not routine. That's the anatomy of a commodity squeeze, the kind we only read about in financial history books, like the one that reshaped the silver market back in 1980. Today, I'm going to walk you through 4 key indicators I personally monitor every day that signal when this situation could intensify. And more importantly, when rule changes might arrive without warning, shifting the entire game overnight. The December 4th, 8th shock event. Let's paint the picture of what allegedly unfolded between December 4th and December 8th. Publicly available, COMEX data suggests registered inventory dropped from roughly 48 million ounces down to around 19 million ounces, a collapse of 29 million ounces in 4 business days. To understand how extreme this is, normal daily outflows in 2024 were around 200,000 ounces a day. This was 145x the normal rate. Like draining an Olympic pool, not with a hose, but with a pressure cannon. Why does this matter? Because registered inventory is the physical silver backing futures contracts. When a trader holding short positions must deliver silver at expiration, they pull from this inventory. But when that inventory vanishes at warp speed, the math becomes strained, and a delivery squeeze emerges. With the December contract expiration closing in, there may not be enough physical metal at these price levels to satisfy every delivery request. That's when markets get stressed. That's when exchanges intervene. And that's when volatility often erupts. What mainstream analysts aren't seeing. Despite the chaos beneath the surface, many mainstream analysts are still pushing the retail coin buying narrative. But the data suggests something entirely different. 1. Massive ETF inflows. Public filings show the iShares Silver Trust absorbed about 590 tons of silver in the first week of December alone. Its largest weekly jump since early 2021. Retail does not move 590 tons. Institutional capital does. 2. Options flow is exploding. Between December 9th and 11th, call buying at the $65 and $70 strikes for Jan-Feb 2026 expiration surged. Big money traders appear to be positioning for meaningfully higher prices within the next 60 days. 3. JPMorgan flips. From short to long. According to their November 26th Commodities Desk report, JPMorgan shifted from net short to net long silver futures, reportedly the first time since 2018. When one of the largest commodity desks on the planet reverses course after 7 years, that is not noise, that is signal. Important disclaimer, I am not a financial advisor. This is not financial advice. Everything here is my educational interpretation based on publicly available information. Always do your own research and consult qualified professionals. The 4 indicators I track daily. These 4 metrics tell the entire story. When they align, historically, major moves follow. 1. COMEX registered inventory. Estimated around 19.1 million ounces as of December 11th. My thresholds. Below 15 million, unprecedented shortage territory. Below 10 million, potential full-scale market strain. Sustained under 20 million, tight conditions likely to continue. This is the critical backbone of the entire squeeze narrative. 2. Silver lease rates. 1 month latest reading, 138% annualized as of December 12th. This is the cost to borrow physical silver. Historically, readings above 50% suggest extreme scarcity. This threshold has reportedly been hit only 3 times in 20 years. 2008, financial crisis. 2020, pandemic, October 2025, recent spike. Each event preceded outsized rallies. Below 20% would signal easing pressure. 3. Backwardation. Spot versus 3-month futures. Current situation, spot 63.74, March. Futures, 64.14, spread 40 cents. Normal spreads should be $1.50 due to storage and financing costs. When spot exceeds futures, backwardation, it signals immediate physical demand outpacing future expectations. If backwardation persists for 5+ trading days, historical data suggests major moves often follow within 30 days. 4. Shanghai premiums versus London spot. Current premium, the STAS was 0.2% as of December 12th. Premiums rise when Asian demand surges. My thresholds, above 2% for a week. Strong stress, above 5%. Extreme tightness. Negative premiums, bearish. China selling into Western markets. Late November reportedly saw brief 5% premiums, signaling real physical competition. When all four indicators align, all four confirming at the same time, inventory under 20 EMAs, lease rates above 40%, sustained backwardation, and Asian premiums over 1%, happened only twice in modern silver history, 2008, 2020. Both times, silver gained over 40% within 6 months. 3 of 4 Kurzgesagt measured rally, 2 of 4 choppy trading, 1 or 0 correction risk. The 3 possible outcomes, based on historical market squeezes, palladium 2020, nickel 2022, silver 1980, here's where the road splits. Scenario 1, the parabolic squeeze. Probability, 30% silver surges to $85, $95 by June 2026. Catalysts, COMEX inventory falls below 20 M-hours, lease rates spike above 50%, backwardation spreads across 90 days. Big industrial buyers lock in multi-year supply. If Shanghai premiums widen beyond 5% and we see 3 straight weeks of 2 plus ounce draws, that's the ignition point. Risk, COMEX rule changes, just like nickel 2022. Cash settlement, delivery restrictions, emergency stock injections. But unlike 1980, retail isn't alone this time. Institutional giants appear to be long too. That changes everything. Scenario 2, the measured rally. Base case, probability. 50% silver reaches $70, $75 by March 2026, then trades in a $65-$80 band. Timeline, late December short covering, potential spike to $72 January, pull back to $60 March. Renewed ETF inflows, push towards $75 confirmation signals, trading firmly above $65 COMEX inventory, stabilizing between 25-30 min ounces. The key checkpoint, January COMEX expiration. If no delivery stress, this scenario strengthens. Scenario 3, the correction reset. Probability, 20% silver peaks between $68-$72 in the next 30 days, then corrects to $52-$58 by Q2 2026. Triggers, weak industrial demand from China. Substitution in solar manufacturing. Shanghai premiums collapsing, lease rates falling below 20%. Biggest risk, a hawkish Fed pivot. If real yields turn positive again, silver historically pulls back fast. What could change everything? 2 things, industrial demand. If it drops for 3 straight months, year over year, squeeze thesis weakens. COMEX inventory above 41 MR would signal pressure fading. One more warning sign, gold-silver ratio back above 75. Historically, signal silver is overextended. The question, no one is asking if COMEX withdrawals continue at half the recent pace. Registered inventory could theoretically hit 0 by late January. What happens then? 2 possibilities. COMEX forces higher prices to attract physical metal. They shift to cash settlement. Both outcomes could send spot prices sharply higher, but through very different mechanics. In 1980, the Hunt brothers were fighting alone. Today, big banks and retail appear aligned, and that changes the entire battlefield. The fundamentals support. The squeeze, 117 ounce deficit projected in 2025. Cumulative deficit since 2021, now around 600 ounces. Mine production stagnant at US 830 ounces. Solar industry demand, 234 milliwatt ounces, plummeted at 18%. EVs, 78 milliwatt ounces, plummeted 22%. AI data centers, 41 per ounces, pulps 37%. Demand isn't interest, it's consumption. Real, industrial, irreversible consumption. Final macro layer, the Fed. On December 11th, Fed cut rates by 25 BPS, forward guidance, 50-75 BPS, more cuts through 2026. Real to 10-year yields now around 0.3%. Silver thrives in negative real yields. Historically, average annual gains, 28% in such environments. Next key dates, December 18th, FOMC meeting December 26th. COMEX, December expiration. Those 2 dates may reveal the entire 2026 trajectory. Silver around $63 with sub 20 in them. COMEX inventory is a combination that historically precedes significant moves. The next 30 days may determine whether we face a structural squeeze, a controlled rally, or a macro-driven correction. I'm tracking all 4 indicators daily. The moment. Inventory drops under 15M lease rates exceed 50%. Backwardation sustains for 5 days. I will release an emergency update within 2 hours. Subscribe with notifications or you'll miss it. See you in the next breakdown.